Hi, kids. Welcome back to APECON. Today, we're going to continue talking about Chapter 6 when the government gets involved and how it affects supply and demand. And today, we're going to be looking at taxes and how that can affect it. So, taxes are anything that the government levies on the citizens. It could be on goods and services, and they use that money in order to pay for different services like national defense, schools, things like that. The government can make buyers and sellers pay the tax. They can choose which side gets it. And the tax can either be on a specific good or it can be on in the percentage, or it can be a per unit tax. So we're going to look at per unit taxes because it makes life a lot easier for us. Sorry, this keeps popping up. Because if you think about it, when you go to the gas station to get gas, they basically make it a per unit tax. For every gallon of gasoline you get, you're paying like a 20-cent gas tax. Or if you were to buy, not you, but if an adult were to buy cigarettes, they have for instance, like $1 per box of cigarettes tax. So we're going to look at it like that rather than like when you go to McDonald's and they say, okay, your total's this. You pay a 10% tax and that's it. So we're looking at per unit. All right, so let's look at the supply and demand for the market of pizza. If the government is not involved and there's no tax, we would see $10 being the market equilibrium price and 500 pizzas being the market equilibrium quantity. But let's assume that the government puts a $1.50 tax on the buyers. If they were to do that, the buyers would now pay $1.50 higher than the market price. However, if the producers wanted the buyers to still buy 500 pizzas, they would have to drop the price of the pizza to $8.50. So that's if they would produce 500 pizza stills at $8.50. But we know that that's probably not going to happen. And if you can see there is a new market equilibrium that is most likely going to drop the price of the pizza a little bit, but it's definitely going to drop the quantity of pizzas bought and sold. So let's look at this new equilibrium. Most likely we're going to see the prices will drop a little bit so that the sellers will get as many people buying pizzas again without dropping the price too much. So we drop down to 450 pizzas being sold, but the price the sellers are getting is $9.50. The price the buyers are paying is $11. So that area in between is the tax. So right here, from here to here, represents the $1.50 tax. And you can see that because they're getting $9.50 and the buyers are paying $11. So they're going to charge a little bit more and the seller's going to get a little bit less, and there's less being sold because of taxes. There we go. There's the tax. Okay. So this is known as the incidence of a tax or a tax incidence. We're looking at how much burden of a tax is shared among the market participants, meaning like who has to pay which part of the tax. So in our example, they're both paying the tax, the buyer and the seller, but the buyer pays $1 while the seller gets 50 cents less. So that's how the tax is split. That's the tax incidence. It's just how the tax is split between the buyers and the sellers. Again, because the original, and they're basing it off of the original market price that didn't have a tax. That's where you figure out how to figure out the numbers of a tax incidence. But let's say the government says, okay, we're putting a $1.50 per unit tax on the sellers. So the tax effectively raises the seller's cost by $1.50 per pizza that they have to pay for because they have to pay the government. So if the sellers will supply 500 pizzas, they could do it if the price got raised to $11.50. Because if it's raised to $11.50, they could still technically sell the pizza for $10. And that would be, but we know that buyers aren't going to want to pay that price. You can see that buyers are not buying that 500 pizzas at a price of $11.50. It's going to happen at the new market equilibrium. This is where buyers are going to buy. Because in this case, like I taught you in chapter 4, there's a surplus. There's more supply than demand, so you got to get it back to market equilibrium, which this is the new market equilibrium because of the tax. So if you notice, the new quantity supplied is 450. It's gone down. The buyers are paying $11 and the sellers are selling it for $9.50. So the moral of the story is it doesn't matter if the tax is solely put on the sellers or if the tax is solely put on the buyers, you're going to get the same price in the end that the buyers have to pay, the same price that the sellers are going to get, and the same new market equilibrium because of the tax. So moral of the story, it does not matter if the tax is solely on the sellers or solely on the buyers. In the end, they're still paying the same price as a buyer and they're still getting the same cash as a seller. So again, like I said, the outcome is the same in both cases, whether it's a downward shift in demand, which is starting here, or the downward shift in supply, which makes the market equilibrium here. So you're going to get the same thing no matter what. So here's what matters. The point is the tax is driving a wedge between the buyers and the sellers. They're having to pay more as a buyer and you're having to get less money as a seller, and it drives a wedge between them, which causes the market equilibrium quantity to go down. So I want you to try this. I want you to pause the video and use this market for hotel rooms to assume that there's a $30 tax and see what the new quantity would be that would be sold, and then the price the buyers would pay, and then the price the sellers would get, and the incidence of tax, meaning like how much they would have to pay more as a buyer, how much they would get less as a seller. Okay, so do this, pause it, do this, and I'm going to go over the answers. All right, here's the answers. So as you will see, the tax of $30 is right here, because if you look, it's $110 right there. And then if you go down to $80, they're still on the supply and demand line, but 110 minus 80 is $30. So that's the tax. So the new quantity at that point is 80 hotel rooms when it used to be 100. So the new price the buyer has to pay with this tax is $110. The price the seller gets is $80. So therefore, since the market equilibrium price without the tax was $100, the buyer has to pay $10 more and the seller gets $20 less, and that's the tax incidence. So let's look at stuff we learned in chapter 5, which is elasticity of supply and demand. When we look at elasticity, that's what's going to determine who has to take more of the burden of the tax incidence, meaning like who is going to get hurt worse with the tax. And it all depends on elasticity. So let's say in this case, supply is more elastic than demand. You can see demand is more inelastic because it's more steep up and down. So if that happens, you can see if that's the tax, you can physically see that the seller does not have to pay as much or doesn't lose as much money, with the tax, where the buyer has to pay way more. The burden is way more on the buyer because you can see when something is inelastic, if the line is inelastic, that's who's going to take more of the burden. When the line is elastic, they take less of the burden. So it's easier for sellers than, in this case, it's easier for sellers than buyers to leave the market. So let's say this is the market for like allergy medicine, okay? No matter what, if you have bad allergies, you need that medicine. So if there's a big tax all of a sudden on allergy medicine, very few people are going to stop buying it. So you're going to have to just suck it up and deal with it and pay that tax. So the burden for that tax is going to be more on you. So let's look at it the other way. Let's assume supply is super inelastic and demand is much more elastic. Look at it like this. Here's the price with no tax. And then all of a sudden we put the tax in. There's the price the buyers have to pay. This is the amount of money that the sellers are going to get. you can see the burden is way more on the sellers than it is on the buyers. So it's much easier for the buyers than the sellers to leave the market. So it's not going to hurt the buyers as much. So again, moral of the story is whoever has more inelastic curve, meaning the supplier or the demander, when it's inelastic, they have the burden. Hang on just a second. I've got to pause it because I have a meeting. Sorry about that. I had to take a pause for a meeting. All right. So, what I was going to tell you is that you've seen how elasticity affects taxes. You've seen how the tax incidence can be either on the buyer or the seller, but they will share it in some way, shape, or form. So, now that you guys know the stuff, we're going to go to Carnegie Hall. You guys are going to practice, practice, practice. I've given you a lot of situations. With the worksheet, you guys do it yourself. Have a good one. I'll talk to you later.